Welcome to this lesson. The title of the lesson is The Financial Coverage Part 1, an overview of the sources of finance. So this is the first class that we'll leave on financial coverage, and we'll talk about the sources of financing for a project. So the outline is as follows. First of all, we'll have a brief introduction. Second, we'll talk about traditional sources of financing. So we are mainly talking about equity contribution from the sponsors of the project and borrowing from banks and private investors. Then we have non-traditional sources of financing. Here we are referring mainly to leasing and factoring. Then we'll briefly talk about institutional sources, and here we mean the investment from institutional investors. Then we'll talk about innovative sources of financing, and here we have a set of possible sources of financing that present flexible characteristics that can be adapted to specific needs of the projects. And finally, we'll summarize the issues about the sources of financing of a project, talking about the structure of project finance. Okay, so we can start with the introduction. So we have to remember that any project requires financing, and sources of financing, as we were explaining in the last class, are acquired from investors in exchange of some expectation of return. So the concern of the sponsors about project financing are three. The first one is to find the potential sources of financing. Then is to understand how to build the capital structure on the basis of the available sources of financing, and then understand what the cost of capital is implied in that financial structure. So these will be the topics that we'll deal with in this class and in the next classes. So as concerns the available sources of finance, typically project sponsors have a number of options for raising funds, as we'll see in this class. And typically, traditional sources are approached first, but new sources are available. So first of all, project sponsor seeks equity from owners or debt from banks and other subjects. And then if these traditional sources are not enough to cover the financing need of the project, they try also new sources of financing, as we'll see. Here, one distinction that is important to make before going on with the lesson is that you can have different situations depending on whether you have a special purpose vehicle for this project or the project is realized within an existing firm. When you have a special purpose vehicle, this means that you create an ad hoc firm just for this project, so the project finance structure specifically refers to the project and is clearly identifiable. Instead, when the project is realized within an existing organization, there is some degree of overlap between the finance structure of the project and the finance structure of the firm. So in this case, the financing structure of the project is less clearly identifiable. So let's start from the traditional sources of financing. Here, the first source of financing is equity. And then we have financial debt. Equity can come in forms of ordinary equity or preferred equity. Financial debt comes in the form of loans and short-term borrowing and bonds. So when we look at traditional sources of finance, we have to distinguish two main possible ways to acquire these sources. So you can acquire new equity or new financial debt through private placements or through the capital markets. And the other distinction that is to be made is that some of these financial sources are long-term, such as equity and loans and bonds, and some of these financial sources are short-term. So the distinction between long-term and short-term financial sources is based on a conventional wisdom according to which short-term sources of financing are repaid within the next year, whereas long-term sources of financing are repaid after 1 year. So let's give a more detailed look at equity and financial debt. So as we can see from this slide, we have two types of equity: ordinary equity and preferred equity. So ordinary equity refers to common shares that are typically issued to project sponsor and confers the typical rights of ownership that we'll analyze in more detail in the next classes. Preferred equity instead is a specific type of equity that is a particular characteristics of offering to the equity holder a guarantee on the dividend. In fact, the preferred ordinary equity has no guarantee on dividend. There is no obligation for the firm to pay dividends to common shareholders, whereas preferred equity is typically this guarantee on the dividend. On the other side, preferred equity is also characterized by limited voting rights. So preferred equity is typically issued to these investors that are more conservative. They require anyhow a given minimum return, and they're not really concerned about the decisions about the project, so they are not interested in voting rights. If we look then at financial debt, we can see that we have distinction between loans and short-term borrowing on one side and bonds. The difference is that loans and short-term borrowing are typically negotiated with the bank, so on the contractual basis, whereas bonds are issued in capital markets and bought by private investors. They can also be bought by banks, but typically they are bought by a wider set of investors, and they are bought on a capital market, typically on the bond market. The difference between loans and short-term borrowing then is referred to the maturity. So loans are typically long-term oriented loans negotiated between the firm and the bank. So they are typically paid over several years. On the contrary, short-term borrowing is a sort of on-demand credit that the banks makes available to the firm. So in other words, the banks create a line of credit that is available to the firm, and there is a maximum amount of credit that can be used, and the firm can use this amount of credit depending on the funding needs. In this case, the typical form of short-term borrowing are overdrafts and revolving facilities. So the only difference, they work basically in the same way. The only difference is that revolving facility typically cover a cyclical needs, whereas overdraft have a more general nature, and they use it for different kinds of financing need of the firm. So this is about the main traditional sources of finance, but there are other traditional sources of finance. So first of all, there are subsidies and grants. Subsidies and grants are typically provided by the governments or other public entities that are interested in the social objective of the project. So subsidies typically cover a given portion of the production cost, whereas grants help the firm financing the part of the fixed assets that are needed for the investment projects. Sometimes in exchange of subsidies and grants, the entity acquire a given share of equity. Then we have supplier's credit. Supplier's credit is a non-financial form of debt. In this case, supplier credit refers to lines of credits that are made available by suppliers of raw materials or fixed assets. So in other words, suppliers act as banks, allowing the firm not to disburse immediately the money needed for the fixed assets, but allow the firm to pay this amount over time in several years. And clearly the suppliers in this case are charging an interest rate to the firm for in exchange of this financial service. And finally, we have internally generated funds. So hopefully, at some point in time during the life of the project is generating cash flows. Or it can happen that the firm is not only managing this project, but is also managing other projects that are generating positive cash flows. So sometimes the firm can have internally generated funds that are available for investment. So in this case, I don't need to acquire new financial resources from external investors, but I can use this internally generated cash. It's anyhow important to remark that when a firm is using internally generated funds to finance a project, internally generated funds are equivalent to equity, because internally generated funds are funds that are not distributed to equity holders as a dividend. So potentially this cash available could be used to pay dividends to shareholder. So it's like as the shareholder were investing their dividends into the company. And so when we look at the financial structure, internally generated funds are equivalent to equity capital. So we have finished with the traditional sources of finance. Now we have the non-traditional sources of finance. And one of the most important source of non-traditional source of project finance is leasing. So leasing is a specific form of credit that the firm can acquire in the moment it buys a fixed assets. So in this case, there is a financial intermediary that is buying the fixed asset for the firm, and the firm is paying for the fixed asset in different installments over time. So clearly the financial intermediary is charging an interest rate for that, but leasing is important for the financing of a project. Is potentially important because it allows the firm not to disburse immediately the amount of money that is needed to buy a given fixed asset. In this case, the amount of money is disbursed by the financial intermediary. Moreover, the leasing in some countries has also some tax advantages over other forms of financing of the asset. So it's increasingly used by different firms to buy the fixed assets that are needed for a given investment project. Then we have another important source of financing for a project. This source of financing is factoring. So factoring involves the sale of future and present receivables to a bank. So a firm that has receivables that will be paid by clients in 3, 4, 6 months can basically sell to the bank, sell them to a bank in exchange of a given amount of money. Clearly, this amount of money will be lower than nominal value of the receivables, and this is because the bank is applying an interest rate on this transaction, and it's also charging the firm a fee for the service. We can have two types of factoring. There is a factoring where the bank is assuming also the credit risk, and there is another form of factoring where the credit risk is supported by the firm. Clearly, the fees that will be applied by the banks on this form of financing will be higher in the case the bank is assuming the credit risk. Then we have the sale of assets. So what does it mean? It can happen that a firm wants to initiate a new project, and the firm clearly has other assets that are employed in other projects, in other activities, in other businesses. It can happen that some of these businesses or projects are underperforming because the market is not so interesting, the firm has not a dominant position in that business segment. So from a financial point of view, it could be rational to sell the assets related to these businesses and projects that are underperforming. And in this way, the firm will be able to use new financial sources that could be dedicated to the new project. So if the new project is more interesting than the existing projects, some of them could be dismissed, the relative assets could be sold, and there will be new cash that could be allocated to the new project. Then we have what is defined as advance payments. So it can happen that the clients are paying in advance for some products or services that we'll receive later. So there could be specific agreements, above all when you have a complex infrastructure projects that require a long time for construction. Clearly, in this case, the project requires a lot of financing in the early stage of its life during the construction phase that is not producing any revenues. So it can happen that a specific agreement is made between the company and the client is going to pay a part of the future revenues in advance to help the company financing the construction phase. And then we have a specific form is the export credit facilities. So export credit facilities are specific forms of financing that are designed to support credit. So they are used, for example, when a firm receives an order from a foreign client. The order could require the buying some fixed assets, raw materials, there could be other costs for production and distribution and shipping of the products. And so in this case, using the export credit facility tool, there could be an intermediary that funds the firm in the production phase and then is repaid in the moment the product is shipped to the foreign client, and therefore the company is paid for selling the product. After that, we have what is defined as institutional sources of financing. So this particular source of financing can be used only when the project has a large size. It's typically non-convenient and non-feasible for projects that have a smaller size. And in this case, we refer to the financing that is provided by typical category of investors, that is defined as institutional investors. So among institutional investors, we find basically pension funds and insurance company. Pension funds and insurance companies manage large pools of financial resources that are financial resources invested by retirees and policy subscribers. So clearly these financial resources are invested in expectation of a future return. And therefore pension fund and insurance company typically invest this pool of financial resources in different kinds of financial and real investments. However, is it easily understandable, these kind of investors are typically highly risk averse, so they look for conservative investments. And so in this case, it's possible to refer to these institutional investors only if the project is not too risky, because otherwise the project will not be an investment in line with the objectives of these institutional investors. Then there are mutual funds. Mutual funds are financial intermediaries that manage, again, a large pool of financial resources that are invested in several different ways. There are different kinds of mutual funds, and depending on their investment strategies, you can find more aggressive mutual funds and you can find more conservative mutual funds. So it's possible to refer to this kind of mutual funds even though the project is risky. Clearly, if you identify those mutual funds that have investment targets that are aligned with the risk of the project. There are some a particular category of mutual funds that invested in so-called venture capital funds. And venture capital funds are the most aggressive mutual funds that typically funds startups and new ventures. So in this case, you could refer to venture capital funds when you have to fund a project that is requiring the creation of a new company with high level of risk, both from a technological and market point of view. Finally, you have social security funds. There are some countries where there are specific entities that are managing social security funds. Clearly, as you can understand, social security funds are the most conservative funds that you can find. So you can refer to this kind of funds only if the risk of the project is very low. Finally, we have a last kind of financial sources that is defined as innovative sources. And here we find different kinds of innovative debt financing. And we find different innovative sources that are defined on the basis of their specific characteristics. So one first type of innovative debt financing is international syndicated loan. So this is a loan that is negotiated with financial investors. The difference from the loan that we have already considered among the traditional sources of financing is that in this case there is not only one bank that is providing the loan to the firm, but there is a syndicate of banks. This means that there is a pool of banks that is providing the total funding, and each of the banks in the syndicate is providing a given proportion of the total funding. So each bank is providing less than the total amount, and clearly is sharing the risk with all the other banks in the syndicate. And typically in the syndicate, there is one bank that is typically the most renowned bank, the bank that has the strongest track record, that is acting as lead manager. So it's a bank that is arranging the contractual feature of the loan, and negotiate the loan with the firm, and after that the loan loan contract is signed, is in charge of managing the loan and relationship with the firm. So this kind of loan is typically used in projects that have a large size, above all projects that have international characterization. In this case, you will have a pool of international banks that typically do not operate only in one country, but operate worldwide. Then you have floating rate notes. These are specific tools of financing that are issued in capital markets, where the specific characteristics is that the interest rate that the firm is paying to the investors is not fixed, but is floating and is typically adjusted to an international standard. The most common international standard is LIBOR, that stands for London Interbank Offer Rate. So what happens is typically that when the LIBOR changes, also the cost of lending or borrowing for the bank will change, and the higher cost of borrowing for the bank will be entirely passed to the firm. So this means that when an investor is buying a floating rate note, it will not suffer for interest rate change risk, and so in this case, the bank or the other investor is available to accept also a lower interest rate, given that the interest risk is shifted to the firm. Then we have a flexible maturity loan. This is a form of financing that is similar to the floating rate notes. There are two differences. As this is a loan, it's not a note. So it's not a security that is issued on a capital market, but it's a loan that is typically negotiated with the bank. The second difference is that here also there is a floating interest rate, but instead of changing the annual the periodical payment, as it happens for floating rate notes, in this case the payment is constant. So when the interest rate is increasing, what is changing is not the periodic payment of the firm, but what is changing is the maturity. So when the interest rate increases, the firm will always pay the same amount of money to the bank in any given period. Simply the maturity will be longer, so that in this way the bank is compensated for the higher interest rate. Then we have inflation-adjusted loan. The inflation-adjusted loan is again a flexible form of financing. So in this case, the difference is that it's not the interest rate that is changing, it's not the maturity, but what is changing is the principle of the loan. So, the principle is linked to some consumer price index. So what is the objective of subscribing an inflation-adjusted loan? The objective is that an inflation-adjusted loan protects the bank from inflation risk. So what happens is that when inflation increases, contractually also the principal increases. So in real terms, the amount of debt will not be affected. So inflation-adjusted loan protects the bank against the risk of depreciation of the principal due to inflation. So also in this case, for the bank, there is a risk coverage. In particular, this form of financing is protecting the bank from the risk of inflation. So also in this case, the firm should be able to borrow the needed money at a lower rate of interest. And finally, we have an increasingly used source of financing that is defined as mezzanine finance. So what is mezzanine finance? Mezzanine finance is typically debt, and is a specific form of debt that is subordinated debt. So subordinated debt means that is debt that is a privilege that is weaker than ordinary debt. So in the case of default of the company, subordinated creditors will be paid only if there are available resources. So they're weaker right as compared to ordinary creditors. So mezzanine finance is a hybrid form of financing because it's a form of financing that is in the middle between the debt and the equity in terms of risk of the creditor. In this case, the creditors is going to require a higher rate of return, a higher interest rate, because this is more risky than the ordinary debt. Okay, so at this point we have analyzed all the possible sources of financing, so traditional sources, non-traditional sources, institutional sources, and innovative sources. Now what we'll see to conclude this class is to understand how these sources are used in order to cover the financing need of a project. And in order to understand how these different financial sources cover the financing need of a project, we have to look at what is defined as the structure of project finance. That is the last topic of this class. So in order to understand how different forms of financing cover different financing needs of the project, we can analyze the structure of the project finance that here is represented through a table. And this table in particular is a balance sheet. Okay, the balance sheet is a financial document where you find on the left side the assets of the firm, or in this case of a project. And on the right side, you find the liabilities. Okay? Well, assets are the assets that are bought and used for the realization of the project. Liabilities represent the sources of funding that are used for to cover the financing need of the project. So as you can see on the left side, so on the asset side, we find fixed asset and long-term pre-production expenditures. So these are the investments that are typically made at the beginning of a project, and they've already been discussed in the last class. So these assets having a nature that is long-term nature are capitalized in the balance sheet, and they are then depreciated year by year. And this is why we find them in the asset side of the balance sheet. Then we have also the current assets. As we have discussed in the last class, current assets are receivables, inventories, and cash in hand. These are the typical forms of current assets that are used in a project. So how are these assets covered? Well, these assets are covered typically by different forms of equity financing, so ordinary and preferred equity, different forms of long-term debts, so loans or bonds, and different form of short-term borrowing from banks, but they are also covered by what we have defined in last class as current liabilities. So current liabilities are mainly represented by payables and advanced payments. So they are a form of operating debt that is generated by the management of the project, and we can say that spontaneously covers part of the financing need related to the current assets. So this representation of the assets and the relative sources of financing is important because in order not to have problem with the coverage of the financing need of the project, we should have that long-term financial sources should cover long-term financing needs. So in other words, the financing need that is related to long-term assets, so the financing need that is generated by fixed assets and pre-production expenditures, should be covered by equity, that is by definition a long-term source. As we'll see in the next class, that there is no obligation or redemption. So by definition, it's a long-term source. And then we have long-term debt. So in order the project to be in equilibrium, in order not to have a problem with the reimbursing of debt, the sum of equity and long-term debt has to be higher than the fixed assets. Because fixed assets will produce cash flow only in the long term, so the repayment schedule of the financial sources has to be aligned with the cash flow plan generated by the fixed assets. Then current assets have to be covered by short-term debt and partially also by long-term debt. But what is important here in the short-term financial sources to distinguish short-term borrowing from current liabilities, because short-term borrowing is specifically negotiated with the bank to cover the financing need of the project. So it's a form of financing that is contractually defined with the bank with the specific purpose of funding the project. On the contrary, current liability, as I was saying before, are generated by the management of the project, by the activities of the project, so typically by suppliers' credits that we were discussing before. And so they spontaneously fund part of the current assets generated by the project. So as we have already discussed in the last class, we can define the net working capital here in yellow as the difference between the current assets and the current liability. So the net working capital is representing the net financing need that a project generates in the short term. And so that has to be covered by the short-term borrowing. So say that we can look at the balance sheet in a slightly different way. And in particular, we can highlight what is defined as invested capital. So here the difference is that instead of reporting the current asset and current liabilities, we are subtracting the current liabilities from the current assets. So as a result, we are getting again the net working capital. You know, from an algebraic point of view, it's exactly the same, because either you report the current assets and the current liabilities respectively on the left side and the right side of the balance sheet, or you eliminate the current liability from the right side of the balance sheet and you subtract then from the left side of the balance sheet in order to get net working capital. So this new representation of the balance sheet of the project is the advantage of evidencing what is defined as invested capital. So the invested capital is defined as the sum of fixed assets plus pre-production expenditures and net working capital. So this is basically all the investment that is required by a project, both in long term and in short term. So when we represent the balance sheet in this way, on the left side we are measuring the financing need required for the total investment of the new project. And what do we have on the right side? Well, on the right side we have the financing sources that are specifically negotiated with banks and other investors to cover the financing need generated by the invested capital. So this representation of the balance sheet has the merit of representing in a clear way the financing need of the project on the left side and the financial sources that are used to cover this financing need, without considering on the right side the current liabilities that are instead not negotiated with the banks but spontaneously generated by the operations of the project. And just a final remark before closing this lesson. Clearly here we are assuming that a project has its specific balance sheet. As I was saying at the beginning of this class, this is perfectly true when we have a specific firm that is created just for this project. So technically we have what is defined as special purpose vehicle. So the balance sheet of the special purpose vehicle is basically coincident with the balance sheet of the project. When instead the project is realized within an existing organization, identifying the balance sheet of the project is a bit more difficult, because there could be some kind of confusion between the financial sources of the project and financial sources of the firm as a whole, as it can happen that firms raises new debt for several different purposes, including the project, but there is not a specific link between the new debt that is raised and the financing need of the project. So this class is ended, and as always, I remind you that if you need more information, you can always look at the website and to get all the materials that is uploaded on the website of the course. Thank you.